a real pleasure for us to be meeting in person for the first time in 3 years, and a real pleasure especially to be hosted by Kristalina Georgieva, Managing Director of the IMF, and her whole team. Thank you very much, Kristalina, for hosting us this time. We have, as usual, an excellent cast of speakers, all prominent faces in global finance and economics. I don't intend to speak very much at all, or in this introduction, but suffice to say that this time it is more complex. It is more complex in every dimension. I noticed that our first panel is called Policy Responses in a Pandemic and Conflict-Impacted World, but it's not just the pandemic, and it's not just geopolitical conflict. It is multiple crises affecting rich and poor within societies, affecting the drivers and the innocent bystanders, affecting low-income countries and the wealthiest. And it's not just about a crisis today. It's not just about multiple crises today. It's about an era that we have entered, an era of enduring uncertainty and fragility. And we have to find bases for optimism in this era, real bases for optimism, not just rhetorical, but bases for investment, for growth, for collaboration, and above everything else, bases for tackling the overriding challenge of the global commons. And I'd like to start by requesting Kristalina to give us a perspective that addresses the themes of both our panels, the first panel being that focused on monetary and fiscal policy and macroeconomic policy in general, and the second panel concerning a very worrying prospect of debt distress in several regions of the world. Kristalina, thank you.
Thank you. Thank you very much, Tarman. It is very telling that the tougher the environment becomes, the easier it is for people to remember my last name and pronounce it correctly. And it is because, indeed, the IMF is a countercyclical institution by the nature of our mandate, and we are in a particularly complex time today. It is a fundamental shift from the last decades of relative predictability that led us to enjoy the benefits of a rule-based international order, translating into improvements in standards of living for hundreds of millions of people, low inflation, low interest rates, to a period of time of much higher volatility, a period of geopolitical tensions and risks of fragmentation of the world economy, and what we are experiencing right now, high inflation, high interest rates that demand the focus of attention of policymakers. And this is what happened during this week. What gives me ground for optimism is the unity of purpose we have pursued during the meetings, and the fact that we are coming out of the meetings with a much clearer focus of what is necessary to stabilize the world economy and put it on a sounder footing for tomorrow. Not easy, but clear. So what is the path in this period of uncertainty that we can foresee we have to step on? First, a recognition that inflation is a tremendous risk for growth and well-being of people. And therefore, we have to focus on winning the fight against it. For central banks, almost everywhere, Kuroda-san, Japan is this healthy exception, are now at the time when they have to increase interest rates in a consistent and prudent manner to bring inflation down, and most importantly, retain inflation expectations well anchored. Second, we have a clear recognition that we are in a much more complex policy environment today than we were in 2020, when once we diagnosed the economic fallout from COVID, we had monetary policy and fiscal policy all working in the same direction of accommodation, whereas today monetary policy tightens, whereas fiscal policy has to recognize the hardship on people and come up with well-targeted and temporary measures to support the most vulnerable. And there we got a very strong call from our membership for the fund to be specific in our bilateral surveillance what exactly we mean by targeted and temporary measures, and use our multilateral surveillance for our members to share experience and learn from each other. 3, there was a recognition that risks to financial stability are growing. A rapid and disorderly repricing of assets could be magnified by existing vulnerabilities such as high public debt and also poor liquidity in some parts of the financial market. 4, we recognize that what makes economies strong is the relentless pursuit of structural reforms. And I remind people, my predecessor, our fantastic Christine Lagarde, saying, when the sun is shining, fix the roof. Remember this message? Yes? Okay. So here I am coming in her footstep and saying, those who haven't fixed the roof when the sun is shining, now it is pouring. You guys better get up there and fix it. And actually, joke on the side, it is paramount to have strong fundamentals in a more shock-prone world we are now going to be living. And last but not least, there was a very clear recognition that emerging markets and developing economies are at particularly high risk. They are being hit by high food and energy prices, high inflation, and on top of it, strong dollar. The high level of debt for many of them, it has gone up during COVID, and the high costs of servicing this debt at the time of interest rates climbing. And that recognition that we have to mobilize to support emerging markets and developing economies, especially the IMF and the multilateral development banks, our responsibility to do it has been very clear. It also brought a message to major central banks, especially to the Fed. I want to quote the Minister of Finance of Nigeria, who said, I wake up every morning thinking about what the Fed may have done. And that is a reality for emerging markets. It also puts an extra responsibility to major central banks, how they communicate, but also to the fund, what we do. So we are in that a place of recognizing that stabilizing the world economy is possible, but only if we have prudent policy response and if we work together. I want to tell you what we are mostly worried at the fund, and it is missteps. It is unfortunately, at the time of uncertainty, the probability of making a mistake, policy mistake, is high. And we have to recognize that may happen, and that corrective measures would be then appropriate, and that we have a responsibility as an institution to keep a mirror in front of our members so they can see themselves clearly, you know, comb your hair, get your makeup, do what is necessary as you see your situation clearly. I want to make a point that the meetings were actually quite uplifting on recognizing that there are challenges we can only address working together. Yes, there is geopolitical tension. Yes, it translates into geoeconomic fragmentation. But there are areas where the world simply cannot succeed without us working together. Climate change. Quite encouraging this week to see that we are pulling, and the fund, of course, is taking our responsibility. We are today a systemically significant institution in the fight of climate change, and I want to recognize our membership for giving us this mandate to be so, from policies to financing with our new Resilience and Sustainability Trust. I saw that Finance Minister Nazijemena, I apologize, Jamena, okay. Now I prove that I am very easy to accept people not pronouncing my name correctly because, they roll in my mouth with difficulty. But he's a great minister from Rwanda. He's on one of the panels. Rwanda is one of the first 3 countries to benefit from the Resilience and Sustainability Trust. We also know that we cannot get anywhere on that unless we work together. We have made some progress with the common framework. We now have Zambia and Chad. The issue for us is how to cement a rule for the common framework that gives predictability to countries so they come to it, and also that brings both public and private sector lenders together with the debtors for early resolution given where we are with high level of debt distress. We also saw the issue of digitalization and cross-border payments in this new era coming up as a unifier where we can work together with BIS, with FSB, the IMF stepping up. And last but not least, what I got from the meetings is this sense that people are looking at the IMF and saying, okay, now you guys are on the front line. Demonstrate that you are clear about your role as a firefighter. We are clear about this role. First, we take responsibility for our analysis to be precise and honest at the global level and for countries, to speak truth to power. Second, we recognize our responsibility to be a financier when the situation is tough. We still have $700 billion capacity. I can tell you that countries are coming in much larger numbers to the fund, and rightly so. They're doing the right thing. We have funded 16 countries with about $90 billion since February 24th, since the war started. And we have about 28 requests. I'm actually today going to be meeting with delegations of Egypt and Tunisia, countries where I'm confident you would see us backing them up in this difficult time. We also think of how we can expand our lending capacity through on-lending of SDRs. You know the numbers. The world said 100 billion is fair to transfer through the fund on concessional basis. We are at 80 billion. And I actually would say this: France went from 20% to 30% of SDRs. Why not others? I heard Japan saying we are thinking about maybe doing more. In a tough time, SDRs we have distributed to our members last year with the $650 billion allocation. For those who have strong reserve position, these SDRs are like a sleeping beauty. And I think it is time for the prince to provide the necessary kiss. And I think tough economic conditions, this is our prince. We are also here to bring everybody together. I just came from a meeting of the presidents of multilateral development banks. We have to prove that the multilateral system is one where the whole is bigger than the sum of individual parts. I finished my speaking to the IMFC yesterday. We were running out of time. I wanted to be very short. So here is my summing up. Buckle up and keep going. Thank you.
I'd like to ask the panelists for panel 1 to please come up and join us on the stage, please.
Want to take my seat, huh? No, I couldn't stand in your shoes, Jacob. Don't worry.
Thank you very much. Is the mic working? It's fine? Okay. Thank you very much, Kristalina, for those candid observations and for your leadership and the IMF's leadership in finding a way for the ship to reach harbor. I'm not going to introduce our speakers individually. We know them all, starting with Andrew Bailey, the central banker of the moment, if I might say. Kuroda-san, Jacob Frankel, who co-chairs the International Banking Seminar for me in his capacity as the person who leads the board of trustees of the Group of 30. Klaas Knot, not only the governor of the Dutch Central Bank, but also FSB chair, and Niall Ferguson, decidedly not a central banker, or not yet a central banker, who will provide a, shall I say, now for something really different. So we're going to start with Kuroda-san, please.
Oh, can I speak here or?
Yeah?
I think for speed, why don't we, are you okay speeding here?
Yes, no.
Yeah.
I think so. Okay.
Thank you, Mr. Talman. Today, I would like
Would
to...
you prefer to speak from
Oh,
the
yeah,
rostrum? All right.
They have notes in it. Because of the notes, it makes it cumbersome.
I don't know.
You want me to go? Yes, it's okay.
Thank you, Mr. Talman. Today, I would like to talk about the policy responses since the pandemic began, mainly in the context of Japan's monetary policy. Let me start with the policy responses to the acute shock posed by the pandemic. In the wake of the COVID-19 outbreak, the Bank of Japan acted nimbly to stabilize financial markets through the ample supply of funds. In addition to the provision of yen funds, the provision of US dollar funds through cooperation with 5 other major central banks was extremely effective. To support corporate financing, the Bank of Japan substantially increased its purchases of commercial paper and corporate bonds. Furthermore, a new facility was introduced to provide funds on favorable terms to financial institutions that made loans in response to the pandemic. Other central banks also implemented measures to stabilize financial markets and support corporate financing. As a result, tensions in global financial markets eased and bankruptcies remained at low levels. These measures drew on lessons learned from the global financial crisis. I believe that the experience gained from the crisis where liquidity was provided in a timely manner on a global basis in response to the acute global shock was useful in addressing the latest crisis. As economies have gradually reopened, the role of such pandemic responses is coming to an end. In fact, the Bank of Japan decided last month to phase out the facility. Looking back, central banks' responses to the pandemic were oriented in the same direction. One, to support corporate financing. Two, to conduct monetary easing to support the economy. However, people's responses to the reopening of the economy have had unexpected effects on both demand and supply. For example, vigilance against COVID-19 has had a non-negligible impact on consumption behavior and labor supply. Furthermore, the war in Ukraine has had a significant impact on the supply side. Against this backdrop, many central banks have changed the direction of their monetary policy. For instance, in the United States and Europe, central banks have shifted to fighting inflation that has risen to nearly 10%. On the other hand, while headline inflation in Japan is above the price stability target of 2%, this is mainly due to cost-push factors from abroad, such as rising energy and food prices. When excluding all of those factors, inflation runs at 0.7%. Since headline inflation is expected to fall below 2% next fiscal year, the BOJ is continuing with monetary easing. I will now explain the differences in price dynamics that underlie the policy differences between Japan on the one hand and the US and Europe on the other, focusing on three aspects. First, the upward pressure on prices from demand side is smaller in Japan. While GDP in the US and Europe is clearly above the pre-pandemic level, Japan's GDP has not yet recovered to such a level. This is because, as seen in the fact that most people still wear masks in Japan, vigilance against COVID-19 is deep-seated, especially among seniors, and recovery in private consumption has been moderate. This contrasts with the United States, where private consumption, including dining out and travel, has been vigorous, as consumers are using savings that had built up during the pandemic. In short, the momentum of economic recovery from the pandemic has depended on differences in consumers' responses. Second, there are differences in the labor market adjustment process in the wake of the pandemic. In Japan, firms hoarded labor during the pandemic, supported by government subsidies. As a result, job losses were limited. In addition, in contrast to consumption, the impact of the pandemic on labor supply in Japan was smaller than in the United States, and the labor force participation rate already exceeded the pre-pandemic level. On the other hand, in the United States, changes in behavior due to the pandemic have triggered the great retirement or great resignation, and as a result, the recovery in labor supply has been slow, and the labor force participation rate has not yet recovered to its pre-pandemic level. This has led to an unprecedentedly rapid tightening of the labor market in the US. The third is wage price dynamics. The sharp rise in a wide range of commodity prices due to war in Ukraine has prolonged the high inflation. In the United States and Europe, fears of a de-anchoring of inflation expectations or of a wage price spiral have surfaced. Such dynamics were observed during the Great Inflation. That said, a virtuous cycle between wages and prices is essential for price stability. The problem facing Japan is that this cycle broke down with the collapse of the bubble economy in the 1990s, a major shock that led to prolonged deflation from 1998 through 2012. Firms have focused on securing demand for holding down selling prices and have absorbed cost increases by improving productivity. In this way, they have withheld from raising prices, and both labor and management have favored employment stability and avoided raising wages. In other words, prices and wage setting based on the assumption that prices will not rise has become the norm and deeply entrenched. The BOJ has been conducting QQE to meet the challenge of changing this norm and restoring the virtuous cycle between wages and prices. Nearly a decade of QQE, together with government measures, has steadily improved the economic and employment situation, even though the price stability target has not been achieved in a sustainable and stable manner. The inflation rate has been positive territory, and there have been signs of change in the mindset regarding prices and wages, as reflected, for example, in the increase in base pay for 9 consecutive years. Given these three aspects of current dynamics, in Japan, the BOJ considered it appropriate to continue with monetary easing to support the economy, to ensure a shift in norms, and to ensure the price stability target in a sustainable and stable manner, accompanied by wage increases. Finally, the pandemic and conflicts are ongoing risk factors for some time and may bring about structural changes. The pandemic and consequent changes in digitalization have affected the structure of the economy and the way people work. Moreover, from a broader perspective, it is possible that conflict around the world may affect the trend of globalization, which has been a major engine of global economic growth. So depending on how households and firms respond to these changes, factors such as medium to long-term growth expectations, potential growth rate, output gap may be affected. So central banks need to carefully examine the mechanisms through which these risk factors affect demand and supply and conduct policies based on the premise of a large degree of uncertainty. This will continue to be a major challenge for the conduct of monetary policy. Thank you.
Thank you very much, Kuroda-san. We now move to Klaas. And Klaas, if you could touch not just on the European situation, but make some observations on the spillovers that we are seeing for the developing world.
Okay, yes, Tarman, I would be happy to do so. But I also had a couple of slides. And
I think you press the green button.
Yeah. So, good morning to all of you, and thanks for inviting me on this panel on the global economy and global financial stability, not to say the least here. And my starting point is actually very much the same as also the starting point of Kuroda-san, and that is that high inflation has been set off by a mixture of global shocks. The pandemic first created supply chain restrictions pushing up inflation, which was then subsequently reinforced by strong pent-up demand. And for the euro area, this strong demand effect in the first half of this year was clearly an upward surprise to us. A pleasant one, but that's where it more or less ended. And a similar pattern can actually be observed if you look at the consequences of the energy crisis as a result of Russia's unjustifiable war in Ukraine. The disrupted energy supply, it's a classic negative supply shock leading to elevated energy crisis. But then the governments came in, they've responded with extensive fiscal measures, which then tend to support demand. Now, it's been a recurrent theme of these meetings here over the last few days that if the scope of these support measures becomes too broad, too permanent, and insufficiently funded, if I can put it like that, then clearly this will constitute another upside risk to inflation. But what is important, I think, to realize is that the impact of the shock differs per region. In the euro area, pent-up demand has clearly been less dominant than in the United States, simply because the fiscal response to the pandemic has been more moderate in the euro area. But on the other hand, the euro area is more affected by natural gas supply disruptions, unlike the US, who is a main energy producer itself. And these differences clearly show up in the drivers of inflation. And this is a simple structural VAR model that shows that the picture in the euro area is clearly more balanced when it comes to supply and demand effect. If you were to do this picture for the United States, you would probably see a lot more green and somewhat less blue. Due to this configuration of shocks, inflation has turned out higher and also more persistent than previously was projected. According to our baseline projection within the ECB, inflation in the euro area remains far too high and is likely to stay above our 2% target for an extended period of time. Model projections are, of course, the cornerstone of our decision-making, but they are only one input. And especially in these times of successive shocks that are not, and by definition cannot be, fully captured by the models that underlie these projections. So the unprecedented economic conditions imply a very high degree of uncertainty for inflation dynamics, where we then also have to focus on what happens with underlying inflation trends. And there in the euro area, we have clearly seen a broadening of inflationary forces since mid-2021, with clear and strong price dynamics in a wide range of goods and services, taking inflation to 10% headline in September. And this broadening is clearly also reflected in core inflation. Core inflation was always around 1% for almost 10 years, up until mid-2021. But now, over the last year, it rapidly shot up to 4.8% in September. And I'm afraid we haven't seen the peak of that yet. Other indicators for underlying inflation, measures that reflect common drivers of inflation, confirm this evolution of inflation as well. In this environment, of course, we should be vigilant for a wage price spiral, and it's good to keep in mind that in many euro area countries, actually, a lot of wage negotiations take place in the fall. There are signs of stronger, substantially higher wage demands, and some of which have already also been met. And while incidental inflation compensation is perhaps is very sensitive to support purchasing power, especially where wage growth has lagged productivity growth, inflation will, of course, become more entrenched if high wage increases become a repeat prescription. So to prevent such vicious dynamics, central banks will have no choice but to act according to their mandate to keep inflation expectations anchored. And similarly, targeted fiscal support to shield those that are the most vulnerable to the high inflation is absolutely welcome. But broader fiscal stimulus, as I already hinted at, will push up demand and will simply counteract the course of monetary policy. And if that were to happen, in that case too, central banks will simply have no choice but to act according to their mandate to keep inflation expectations anchored. When inflation is projected to stay above target and economic growth is constrained by inelastic supply, it's clear that monetary policy cannot maintain its expansionary posture that has been in place for over a decade now. And given this inflation outlook, we first have to take interest rates back to levels that bring the economy back in equilibrium, to keep also the expectations aligned with our 2% target. In December 2021, the ECB started normalizing its monetary policy by announcing the end of net asset purchases, and several months later, the net asset purchases were also concluded, the PEP in March and the APP in July. Policy rates have been raised in 2 large steps now, and we expect to increase them further over the coming months. Financial markets have obviously anticipated this, as is reflected also in the strong rise of bond yields since early 2022. Now, as a first step, we will increase policy rates to a level that will provide us with sufficient comfort that we have entered the range of plausible estimates for neutral. While the precise level of the neutral interest rate is of course shrouded by uncertainty, it is clear that at current levels we're not there yet. In any case, I am fully convinced that we need to do more than just removing accommodation to fulfill our price stability mandate. Indeed, the uncertain macroeconomic environment with clear and present upside risks to inflation calls for a risk management approach that would err on the side of resolve. In line with our strategy review, the larger the risks of inflation expectations moving away from our 2% target, the more forceful our response will simply have to be. For now and for the next few months, we will thus be guided onwards and upwards by our data-dependent and meeting-by-meeting approach. And I should add that I do not expect policy rate hikes to come to an abrupt end. But it is also true that the farther we hike and the closer we come to restoring a credible prospect of inflation moving back to target, the smaller future rate steps will likely become. The level to which the policy rate will have to be increased also depends, of course, on the calibration of other tools, including the runoff of the central bank balance sheet. Once we have reached neutral territory with our policy rate, it makes sense to consider the roll-off of asset purchases by limiting reinvestments. And this would help transmitting our tighter monetary policy also evenly across the entire yield curve and ensure that all monetary instruments work in the same direction. Model simulations indicate that lifting the policy rate in tandem with an upward term premium effect helps to reach the target more efficiently, as it lowers both peak inflation and also the required terminal rate. I do believe, however, that we should move gradually here. And to this end, it also makes sense to distinguish between our two asset purchase portfolios, APP and PEPP, the Asset Purchase Programme and the Pandemic Emergency Purchase Programme. The former is an instrument exclusively to steer the monetary stance and should therefore simply be seen as a complement to the policy rate. But the PEP plays a dual role in our toolbox by also countering serious risks to monetary transmission related to the pandemic. And it implies that decisions about unwinding these programs do not have to run in parallel per se. Now, finally, on monetary policy, to ensure that the stance is also transmitted smoothly across all euro area countries, the Transmission Protection Instrument was introduced in July 2022. It supports price stability in the euro area as a whole while preventing unwarranted disorderly market dynamics. The combination of PEP's built-in flexibility with respect to reinvestments, the newly created TPI, the already existing outright monetary transactions, that makes for a richly filled toolbox to counter any unwarranted disorderly market dynamics that would in turn threaten to derail the pursuit of our price stability mandate. Now, that is all I have to say on monetary policy. Tharman, you asked me to also say a few words on global financial stability. It is crystal clear that, of course, this sort of situation that we are in, very high inflation, slowing growth and rapidly rising financing costs everywhere in the economy, that's a situation we haven't seen for 40 years. It sort of brings some vulnerabilities to the fore that were already there for much longer, but will now become much more urgent. High debt levels, the next panel is on that, so I won't elaborate too much on it, but it's clear in some countries it's about household debt, in other ones it's about corporate debt, the sovereign debt issue, but that is the next panel. Another area that worries me a lot, I must say, is the non-bank financial intermediary space. If you look at most of the financial instability events of the last 2 years or so, be it the dash for cash, be it the issues surrounding commodity trading, be it the issues surrounding pension funds in the UK, it all has to do with sort of pockets of hidden leverage that pop up in the system because the system is under strain. And that's logical, that system is under strain, because in the financial system there are a lot of business models, risk management strategies that were built on the low for long, and probably on an expectation that low would be very long and longer than has proven to be the case. But it's very clear that there are strains in this area and that we need to beef up the work also within the Financial Stability Board to make these pockets of hidden leverage have a more systematic sort of stock take of where they could pop up and what to do about it. And then finally, with an eye to the emerging markets, of course, a third vulnerability is the foreign currency debt issue. It's a persistent vulnerability. It has been around for long, but also that is, of course, now on the increase with any rise in interest rates in the advanced world. So I'll leave it with that, Tarman, and then, of course, I'm ready for questions later.
Right.
Yeah.
Thank you, Klaus. Thank you very much, Klaus. And now we move to Andrew.
Well, thank you very much, Tom. And can I add my congratulations to bringing the G30 together again in person. It's really very welcome. We are, of course, getting together in person in what are really the most difficult of times, as others have said. And I think in saying that, we should recognise that however difficult each of our positions is, and we can all describe that, nothing compares to the suffering inflicted on the people of Ukraine. I think in these times, I personally always feel that a large measure of stoicism is called for, and particularly the view of the Stoics that the best indication is what we do and how we behave rather than what we say. But there is an important role for communication. And so I will set out the key elements of UK monetary and financial stability policy as I certainly see them. Just as others have described, the UK economy has been buffeted by very large disturbances in the last 2.5 years or so. There I would point to COVID, the supply chain issues in the COVID recovery, a shrinkage of the labour force during this period, and most recently, of course, the impact of Russia's invasion of Ukraine on energy and other commodity prices. And these disturbances are very large. In the UK, the rise in energy prices means that household spending on energy as a share of income could plausibly be a full 2 percentage points higher this winter than in 2019. And this is bigger than any annual increase we saw in the energy crises in the 1970s. The disturbances that have come since COVID hit have been supply-side effects in the UK. Supply chains, shrinkage of the labour force, cuts in the supply of natural gas to Europe as a whole. And I want to draw out a number of points from this to start with. The first is that when you look at overall activity in the UK economy, it has not experienced a rapid and sustained recovery from the COVID disturbance. The level of GDP on the latest reading remains below the pre-COVID level. And the problem then is that the supply side has shrunk, particularly the labour force, and the economy has been hit, as I said, by a huge shock to national real income from the war. Now, second, it is said that central banks, and I obviously include the Bank of England in this, were incorrect a year or so ago to emphasise the transient nature of these shocks and thus how monetary policy should respond. My response to that is sort of no and yes, really. No in the sense that the monetary policy prescription for how to respond to a single transient supply shock was the correct one. But yes, because what we didn't see was a sequence of such shocks to come without gaps, which invalidated the basis of the transient argument. Because the combined duration of these shocks has kept inflation elevated for an uncomfortably long period of time, given the potential implications for medium-term inflation expectations. Though I would say, of course, that I think when all of us were participating in this event virtually last year, it was hard to see, of course, and predict Russia's behaviour. Third, and I think this is harder and where I'm sure economic historians will find very interesting issues to dissect, could we have foreseen the shrinkage of the labour force and the persistently low level of unemployment despite the prevailing disturbances? I'm not going to judge this, but I will say that I think the two questions that really weigh for me here are, could we reasonably have foreseen at the time that the high level of inactivity in the labour force would persist, even as the pandemic wound down, as I hope it's winding down? And should we have been more sanguine that the end of a furlough scheme, which covered 1 million jobs up to the end, would have no discernible impact on unemployment? But that's really all history. It shapes where we are today, though. Meanwhile, of course, Russia has perpetrated its illegal invasion of Ukraine, setting off the disturbance that has run through the world economy. For the UK, as I noted earlier, and for many other countries, it has been a huge negative shock to real income and to the position of households and businesses. It affects most severely the most vulnerable and least well off because energy as a necessity of life is a much larger part of their consumption. And for us at the Bank of England, it's created a huge challenge for monetary policy because inflation is, of course, well above its 2% target. In early August, we estimated that the direct effects of higher energy prices, that's not including the indirect effects, I should stress, would contribute around 6.5 percentage points to inflation towards the end of this year. Our assessment then was that inflation would peak around 13% and then come down sharply, other things equal, to the 2% target in 2 years' time before falling further to a bit under 1% in 3 years. Now, much of the discussion then in the MPC was around how equal other things really would be. To what extent would the tightness of the labour market exacerbate the impact of energy prices on inflation expectations and thus cause higher inflation to be more persistent? Meanwhile, the impact of the energy price shock has throughout Europe and beyond posed a huge challenge for governments and for fiscal policy. And the consequences of the shock for people are huge and disturbing. Governments have naturally responded. The UK government has introduced a 2-year price cap for domestic household energy prices and a 6-month cap for businesses. This is a major intervention, but it's understandable. The consequences for monetary policy are important. It should cap the peak of inflation, we think, at around 11%, and it should lead to a more rapid fall in inflation back towards target. And other things ought to be more equal because there is greater confidence in the profile of retail energy prices during the period on which monetary policy focuses. But I should stress that, of course, it remains to be seen whether other things really will be more equal. We can't take that for granted, I'm afraid. And we will have to keep a very close eye on that situation. Now, the price cap will add to demand relative to what it would have been without the cap, and thus what we thought in August. It will therefore add to inflationary pressures towards the later part of the 2-year period on which we focus. This is the point at which we thought inflation would come down to and then go below target. Lastly on this, we also have to think about what energy prices will be when the cap is lifted. Now, more recently, the UK government has made a number of fiscal announcements and has set October the 31st as the date for a further fiscal statement. The MPC will respond to all this news at its next meeting in just under 3 weeks from now, just after the 31st of October. This is the correct sequence, in my view. We will know the full scope of fiscal policy by then. But I repeat what I've said already. We will not hesitate to raise interest rates to meet the inflation target. And as things stand today, my best guess is that inflationary pressures will require a stronger response than we perhaps thought in August. Now, UK financial markets have experienced some violent moves in the last few weeks, particularly at the long end of the government debt market. And this has put the spotlight on the flaws in the strategy and structure of one important part of a lot of pension funds, as Klaus referred to. At the Bank of England, we've had to intervene to deal with a threat to the stability of the financial system, our other core objective. Now, there may appear to be a tension here between tightening monetary policy, as we must, including so-called quantitative tightening and buying government debt to ease a critical threat to financial stability. And this explains why we've been clear that our interventions on the latter point are strictly temporary and have been designed to do the minimum possible or necessary. So I want to end my remarks by drawing on this experience to make the distinction between monetary policy and financial stability interventions. Let me start by saying that as a central bank, we have to be able to do both at any time. We cannot decline to do one because it appears to be at odds with the other. For me, the test is whether we can still operate each policy in accordance with its objectives at all times. And the answer for me during this period has been yes. But let me elaborate on the difference between the two with 3 important points. I'll start the first. The first is one of definition. Monetary policy should be seen as the active setting of interest rates, or more broadly influencing risk-free yields in order to meet the inflation objective given prevailing economic conditions. Financial policy, meanwhile, has a broad sweep. In the context of our recent gilt market operations, it is aimed at preventing overall financial stability from being threatened by severe dislocations in some financial markets. It's not about steering market yields towards some particular level, but rather preventing them from being distorted by market dysfunction. Now, that distinction may not always be as clear in practice as it is in principle, but on this occasion I think it was. The jump in long-term yields in the hours before our intervention was accompanied by a sharp widening in bid-ask spreads. For shorter maturities, historically the more liquid part of the market, both yields and spreads moved significantly yes. We've had a very clear message from market participants about the stability-threatening dynamics of this process. On that first day, it took only a small number of purchases to reduce the 30-year yield very significantly. So all this suggests that whatever the fundamentals, the particular behaviour of the long end of the curve was caused by a liquidity event. Second, the operational details also differ significantly. The MPC's decisions on QE have targeted a specific stock of asset holdings. But for financial stability purposes, we're not looking to buy any particular amount or cap or control yields. Our aim was to restore liquidity and to provide time for so-called liability-driven investment funds to reduce leverage. Unlike QE, our financial stability operation was very much a short-term one. It ended yesterday after only 2 weeks of operation. The third and last point is that the MPC is not using the stock of asset holdings as an active tool of monetary policy at present. As we've made clear over a number of years, once bank rate was away from the lower bound and could move in both directions, the intention was to unwind the stock of QE gradually and predictably, and in a way that wasn't bound to underlying economic conditions. Because instead, monetary conditions are now steered by bank rate, the primary instrument of policy. And should monetary conditions prove too loose to meet the inflation target, given the economic news, it's bank rate that responds. And whatever the source of any disturbance to monetary conditions, the MPC is free to offset these disturbances by means of its primary instrument, bank rate. But I'll just end by saying that I think this example and this case study, if you like, shows that in difficult times we need to be very clear on this framework of intervention. Thank you.
Thank you, Andrew. That was very clear. Thank you. Over to you now. Would you prefer to speak from? Yeah. Mm-hmm.
Well, Tarman, you promised something completely different. May I remind you that Monty Python, which made those words famous, aired between 1969 and 1974, significant dates. I must say I wish Paul Volcker were here. I suspect I'm not the only person in this room who misses him now more than ever. I really hope he would have approved of what I'm going to say. During the interwar era, in other words, the period between Cold War I and Cold War II, many economists and policymakers lost sight of the role of war in the global economy. Because the wars of the interwar era were quite small, Bosnia, Afghanistan, Iraq, more closely resembling colonial policing operations, we forgot that war is history's most consistent driver of inflation, debt defaults, even famines. And that's because large-scale war is simultaneously destructive of productive capacity, disruptive of trade, and destabilizing of fiscal and monetary policies. If you plot global battle deaths from interstate conflict against inflation, I'd have produced a slide to show this if I'd known slides were allowed, you'll see that behind the so-called Great Moderation, there was a period of declining global conflict that lasted from the mid-70s actually until the outbreak of the war in Ukraine. The coming of peace, like monetary policy, acted with a lag. The events of this year have reminded us what's at stake in cases of great power conflict. The war in Ukraine qualifies as such a conflict because Russia is still clearly a great enough power that it would by now likely have achieved its annexationist aims had it not been for large-scale financial and military not to mention technological assistance to Ukraine from the United States, the European Union, the United Kingdom, and other associated states. This is a big war, measured by both casualties and costs. Now, the economic importance of wars, and especially world wars, was highlighted some years ago by a Barrow and Ursua paper from 2008 of the 70 consumption and output disasters they identified for OECD countries. Fully a third were war-related. In a new paper, which I've co-authored with Martin Corneliu, Paul Schmelzing, and Moritz Schulrich, based on 4 centuries of data, we show that central bank balance sheets have very often expanded in response to geopolitical as well as financial crises. They didn't call it quantitative easing back then. Now, economists like to treat or tend to treat wars as exogenous shocks because they're kind of hard to model. But from the historian's standpoint, war isn't exogenous. It's the endogenous prime mover of the historical process, the father of all things, as Heraclitus famously said. So 2 general points are really important to notice. First, wars have played a very noticeable role in the history of inflation expectations. Thanks to the excellent historical work of the Bank of England, we can trace the history of UK inflation expectations all the way back to the late 17th century. The peaks in short-run expectation nearly all align with wars, and generally years when the war wasn't going well. 1709, War of Spanish Succession, 1757, the 7 Years' War, 1800, Napoleonic Wars, 1917, 1940. 1975 is the exception, but you could link that to the consequences of the 1973 Arab-Israeli War. The second point is that wars have often been responsible for discontinuities in the history of interest rates. As Paul Schmelzing has argued, work that the Bank of England first published, there's been a long-term supra-secular stagnation, meaning a downward trend in nominal and real long-term rates dating back to the period after the Black Death, which was, of course, almost certainly the biggest pandemic in history. The major breaks in that long downward trend were nearly all associated with wars, particularly big wars that destroyed capital stock and generated monetary financing of debt. Now, an unusual feature of the recent past is that in 2020, a pandemic had the fiscal and monetary consequences of a world war. This was unprecedented. No previous pandemic, including the much more devastating 1918-19 Spanish influenza, had comparable responses from finance ministries and central banks. Because most, not all, but most countries followed the United States in offsetting the supply shock caused by lockdowns and spontaneous behavioral changes with both large-scale deficit finance transfers and significant monetary expansion, the first pandemic year was associated with extraordinarily large deficits and monetary growth rates, actually comparable with those of world wars. It's hard to find any precedent for that in the history of past pandemics. Unfortunately, major policy errors were committed in the second plague year of 2021. The newly elected Biden administration embarked on an overambitious transformative fiscal stimulus, while the Federal Reserve retained its accommodative stance, even as the rapid rollout of highly efficacious vaccines permitted a return to normal social and economic behavior. Like those who thought the pandemic would last forever, those who argued that inflation would be transitory like at the end of World War II turned out to be wrong. Those who saw a better analogy with the Fed's great mistake, Alan Meltzer's phrase, of 1968, have actually been vindicated by the persistence of inflation. Most accounts of the great inflation of the 1970s tend to underestimate the role that war played. If I had more time, I'd go into that. It's not just about 1973, it's also about Vietnam and other conflicts of the 1970s. In 2022, a war played an analogous role to the War of 1973 in pouring kerosene on an inflationary fire that was already burning. Both food and energy prices were driven up by the outbreak of the war and the sanctions imposed on Russia by the US and others. It goes without saying, I think, that the return of great power conflict has made the life of policymakers difficult, just as it did in 1973. I recently heard it said, at a gathering rather like this one, that the 20s are unlikely to be as inflationary as the 1970s on the ground that labour is less organised and so the risk of a wage price spirals lower. But I want to draw your attention to 10 important differences between our contemporary situation and the situation in the 1970s. 1. Monetary growth rates were significantly higher between Q2 2020 and Q2 2021 than at any point in the 1970s, and they remained in double digits even after velocity had recovered. That was the policy mistake in my view. 2, productivity growth is lower today, much lower actually in all OECD countries than it was in the 70s. 3, demographic trends are worse today, with significantly higher dependency ratios. 4, the fiscal positions are much worse today, with much larger stocks of debt and projected deficits, not least in the United States. 5, financial markets are more complex today and therefore more fragile. There were no such things as liability-driven investment strategies for pension funds in the 1970s. The events of March 2020 exposed, in my view, a comparable fragility in the US Treasury market. Lots of schadenfreude are directed at the UK in the last few days, but let's be careful and not assume that this really is all a consequence of Britain's Monty Python politics. I don't think it is. 6, then we had pollution, now we have climate change. 7, our political stability looks a lot worse than it seemed even at the time of Watergate. Example, in a recent poll, Americans were asked, do you think the nation's democracy is in danger of collapse? 69% of Republicans and the same percentage of Democrats said that they did think so. 8, the current war in Ukraine is lasting much longer than the war of 1973, approaching 8 months compared with 19 days. So far, number 9, there's no sign of détente. Remember détente in the 1970s? In Cold War II, quite the opposite, in fact. So there's a non-trivial risk that we could soon witness a confrontation between the United States and the People's Republic of China over Taiwan. 10th, and finally, although media attention currently focuses on the women's protests sweeping Iranian cities, it's worth recalling that these coincide with the failure of the attempt to revive the Iran nuclear deal, meaning that the Iranian regime will likely speed up its effort to acquire a nuclear weapon, increasing the probability of a war in that region because no Israeli government, whoever is prime minister, is going to countenance a nuclear-armed Iran. So, in conclusion, we may get lucky. We may just rerun the 1970s. Though judging by recent events in the UK, we may do it at a rather higher speed, from the Barber budget to the winter of discontent in a matter of weeks rather than years. But, and this I mean very seriously, there is a scenario in which we get something closer to the 1940s, in which regional great power conflicts coalesce into something like World War III, albeit with smaller armies, many unarmed weapon systems, unmanned weapon systems, and far more powerful and accurate bombs. In such a scenario, ladies and gentlemen, we'll have to look for guidance not to Paul Volcker, but to Mariner Eccles, a now forgotten name, and Montague Norman, and we'll look back, I suspect, on the phrase quantitative tightening as an eccentric idea that almost no one was able to execute, the monetary policy equivalent of Monty Python's Ministry of Silly Walks. Thank you very much.
Well, thank you, Niall, for taking advantage of the fact that you're not a central banker to speak with a little less moderation. Questions now. Keep it snappy. Identify yourself. Questions from any quarter. We'll start with the lady in the third row.
We have microphones?
There's a roving microphone, I think. Is someone... Thank you. And by the way, could you keep all our mics on the panel so that it saves time?
Thank you very much. Puma Kemes from Autonomous Research. If anything, we've been reminded that low probability events are not zero probability events. So not to make our esteemed panel rerun your nightmares, but what keeps you up at night? And if it is non-bank institutions, what is available in the richly available toolkit? Thank you.
Thank you. We'll take one more question first. Mohammed, you're about to say something? Good. I thought you were.
It was an invitation.
Okay, answer that question. Klaus, you want to start on that?
Yeah, well, I have already partially answered. First of all, nothing keeps me awake at night, because I think there is nothing to be gained by... well, unless, of course, we were to have a crisis like in the UK, then probably I would also have to make a few all-nighters. But no, I already sort of answered that. I think the NBFI space is clearly an issue of high attention. And there is an issue also there that this space, of course, is not as homogeneous as the banking space. So I think we had the global financial crisis 2008, 2009. We fixed that by significantly increasing capital buffers and resilience in the banking sector. So that's why I think currently in sort of the FSB circles, there's less concern about the banking sector. But fixing the non-bank sector in a similar manner is not as easy, because it's a very heterogeneous sort of sample of institutions with completely different investment strategies and what have you. So what can we do? Well, make sure that we dive as deeply as possible into these, what I called pockets of hidden leverage. Make sure that we open up the data that is there in this space, for instance, in trade repositories, so that we bring as much transparency to the process that is happening there. And then I still would think that sort of some accidents will happen, unfortunately so. I would love to say that I think that that would not be the case, but I think it's a realistic assumption that things will happen. And then we have to fix them, because I don't think it can deviate central banks from pursuing their inflation target. That cannot be the case, I think, as Andrew has rightly pointed out also with his UK example. We need to be, our efforts need to be geared towards separating our monetary assignment as much as possible from the financial stability one. And monetary policy needs to be solely geared towards taming inflation, and will have little space to do anything else. Clearly, as long as we're still on this side of the inflation peak, and any sort of prospect toward of a return toward 2% is shrouded in huge uncertainties.
Thank you, Klaus. There are several people who've indicated already. We'll start with the gentleman in front, then yourself.
It's the Minister from Italy.
Paolo. We'll take those three first. At some point, we'll give people who are not white men a chance. So just hold on a minute, please.
Good morning, Brunello Rosa from Rosa and Rubini. We talked about the potential conflict between monetary and fiscal policy, but I'd like to speak about potentially the inconsistencies within monetary policy. And until a few years ago, it was inconceivable to think about increasing interest rates and doing QE, especially because of the contradictory signals that would send to the market. Now, this seems to be potentially the new norm, in the sense that you use monetary policy in terms of interest rates to control for inflation and potentially asset purchases for either the transmission mechanism or financial stability purposes. Is this becoming a new paradigm potentially, or is just an exception? Thank you.
Thank you. We'll take the next question.
Chris Giles from the Financial Times. It's a question for Governor Bailey. As you know, things are moving very fast back in London, and we have a new chancellor and a new fiscal policy which has moved from being the largest tax cuts in 50 years to now being tax increases and public spending cuts. How do you see the change in fiscal policy overnight affecting both the monetary policy situation in the UK and the markets opening on Monday?
Former Minister.
Pardon.
Thank you
you very much. Pardon, Unicredit. This has been a fascinating panel. I have a question for the central bankers, but also for Neil Ferguson. One element which comes out of, after listening to the doom list that Mr. Ferguson just provided us, is that monetary policy can be extremely efficient. You can do a great job, but it will not be enough. So my simple question is, how do we see going forward a policy response which counts on all the policy tools available? Maybe we need a new G20? Thank you.
Very good. I think we will take those three questions first. Kuroda?
Yeah, thank you. Maybe also I would like to say something about the question one. As Klaus already explained us clearly, non-bank financial intermediaries is a big agenda for financial regulators as well as central bankers in the last 3-4 years. On the other hand, the most dangerous possibility of financial crisis is non-bank financial intermediaries collapse or something affecting the banking sector, which would have greater macroeconomic impact. Now, through various efforts, in particular Basel III, the current banking sector in developed countries are much safer and resilient. So that is, I think, is one good point which should be mentioned. Now, of course, the cross-border influence made by non-bank financial intermediaries in one country to another may be a possibility, and because the 2008 global financial crisis initially started in Lehman and others affected global financial system. So we have to be careful, but as I said, the strength of the banking sector is a positive point we have to think about. Second question, it's I think a complicated thing, and from our experience in Japan, certainly QE and the interest rate policy in some case, in the short run, could be used for two separate tools for two purposes. But apparently, in the long run, such kind of separation of QE from interest rate policy is not viable, I think. The question 4 is a bit complicated, and I mean, monetary policy is for price stability, and the central bank's objectives, price stability and financial stability, and various microeconomic matters, including income distribution, and so on and so forth, must be addressed by fiscal policy and structural policy, not monetary policy. So I think there's a clear limit for the central bank to do basically price stability and financial stability.
Thank you. Andrew?
Yeah, I'll take, I'll answer Chris Giles' question. I'll just make a very brief comment on the first question. Chris, I'm sure you'll probably expect me to say this, that I think it's good practice for central bankers not to predict financial markets. But what I will say is this, and it's important. I issued a statement 2 days after, on the Monday after the fiscal policy announcement made by the previous chancellor on the Friday, and I thought I had to. It's not something I make a habit of doing, but given the situation. I also don't make a habit, like I think like all my fellow governors, of commenting on fiscal policy as a rule, because that's not, of course, my job. But I made 2 points on fiscal policy, and they are deliberately 2 points which are of clear relevance, I think, to the central bank. One was to emphasise the importance of sustainability of fiscal policy. And the second, which was really part of that, was to emphasise the need, in our case, to have the Office for Budget Responsibility involved, that flying blind is not a way to achieve sustainability. And those two are very important points for me. The OBR is now very much back in the picture. I can tell you that I spoke to Jeremy Hunt, the new Chancellor, yesterday, and I can tell you that there was a very clear and immediate meeting of minds between us about the importance of fiscal sustainability and the importance of taking measures to do that. Of course, there was an important measure taken yesterday. Jeremy is now working on what will be the fiscal statement on the 31st. It's not for me, and it's not appropriate for me to constrain the choices he makes. But the very clear message I would give, and it's a clear message for everybody, including it's a clear message for markets, I can tell you there is a very clear and immediate meeting of minds on the importance of stability and sustainability. Just on the first question, paradigm or exception. The way I'd answer that is that I think we have to be in the business of being able to meet events that hit us, and we spend a lot of time as central banks doing contingency planning, determining how we can execute operations. So my very clear message is that we have to be able to do what we need to do to meet both our objectives. That's both monetary policy and financial stability. And I just draw out one point I made earlier. We are now in a world where, of course, buying gilts at a point when you are tightening monetary policy, notwithstanding Niall's comments, would like to start quantitative easing. And by the way, by that, to be clear, we mean active purchasing. Most of us are doing passive runoff now, but at varying speeds depending on what we hold as the stock of assets. But we have to be able to do these things, because we can't say, as I said earlier, sorry, can't deal with financial stability because I'm tightening monetary policy. That's just not an option for us as a central bank. So we have to have a toolkit that contains both. It's nearer to paradigm in that sense. But there is a huge premium then on communication.
Thank you, Andrew. Neil?
Well, I don't really need to tell you what keeps me awake at night. I think I already made that fairly clear. If you don't wake up to check for alerts for geopolitical escalation, you're not really understanding how the historical process works. I think if one comes to the question of, is monetary policy sufficient, I'm reminded of a conversation I had with a previous governor of the Bank of England, Mervyn King, about a year before the financial crisis began. And I asked him, what will you do if I'm right in thinking that a crisis in US mortgages is going to have huge spillover effects? And his reply was immediately, monetary policy won't be sufficient in that contingency. We've war-gamed it a lot. Andrew, you probably are aware of this. And we know that there will have to be a substantial role for fiscal policy in such a scenario, as of course proved to be true, and also proved to be true in the pandemic. The idea that monetary policy was the only game in town, which was briefly fashionable in this community, was always a fantasy. And it bore no relation to historical reality, because historical reality, as the paper I cited cites, is that there are periods of over 400 years of very large-scale central bank accommodation of fiscal expansion. And that's how it's worked again and again, particularly in times of geopolitical or financial crisis. So I think it's fairly clear that if I'm right that there is a worsening of the geopolitical situation, you can expect there to be a fiscal and monetary response. The problem is we start from a fiscal point of view, an already quite stretched position. The only consolation is that if one goes back to British history, in the 17th, 18th, 19th centuries, debt to GDP burdens went much higher than they currently are. There's truly much more fiscal room for maneuver for developed economies than most people recognize, because they don't look back far enough. In the long-term perspective, Japan's debt-GDP ratio is not actually completely without parallel. The problem is, it seems to me, that it will be hard, having had a pandemic and then entering a period of geopolitical turmoil, for central banks to cope with the financing needs of governments in a way that is not inflationary. And I think you're bound to see considerable variance, as we saw in the 19th and 20th centuries, between countries as to how far they're able to cope with these fiscal and monetary expansions without generating inflation. I would anticipate in the quote-unquote World War III scenario that governments will increase their interventions in economic life even more than they already have, controlling prices and not just controlling energy prices, intervening in the market in other ways. That's, I'm afraid, the lesson of history. And it's why I think of the last 30 years as a strange interwar period, a quiet interlude, which we all made the mistake of thinking was a new normal.
The gentleman in front, the gentleman at the back there. Yes, yourself, the one who turned around, that's right. And the lady in the middle.
This is Bullard. This is Bullard.
Jim Bullard, St. Louis Fed. So for the central bankers on the panel, you seem to agree that 2023 will be a year of disinflation. Is that because we're still telling the transitory story, or is that because the central banks have taken action that you think is sufficient to start to bring down inflation? And for Professor Ferguson, if you think of the pandemic like a war, especially from a U.S. Perspective, lots of fiscal spending without too much indication of where the future taxes were going to come from, and a lax monetary authority, don't you think we're switching back to the pre-pandemic equilibrium with the prospect of divided government in the U.S. and a very active Fed now? So it seems like that's a story about a soft landing and less inflation in the U.S. going forward.
Excellent question. Thanks, Jim Bullard. Yes, the gentleman there.
Thank you very much, Paul Sheard. It's very understandable that central bankers want to stay in their lane and not be seen to be interfering in any political processes. But given the sobering comments from Professor Ferguson about how much geopolitical issues can impact on the economy, financial system, and therefore drive the policy responses, do you feel, particularly the central bankers, that there are adequate mechanisms in place for the geopolitical decision makers to be well apprised ahead of time as they make their decisions of what the consequences further down the track may be in terms of economic outcomes, inflationary outcomes, financial stability outcomes? So you wouldn't be interfering in any sense, but you would be making sure that geopolitical policymakers were fully apprised of all of the potential consequences of those decisions. And if that is not the case, what mechanisms can be put in place to help that process? Thank you.
Thank you. Next question, the lady in the back. That's right. And then the governor from New Zealand.
Hi, Danai Kirakapulu, Grantham Institute, London School of Economics. You've all rightly observed that looking at the past, these are the most constraining economic, monetary and financial conditions we have faced in a long time. But looking at the future, they may well be the most accommodative we're looking at a long time, given planetary boundaries and the climate change that is damaging our economy. These are fixed and exogenous. They do not adjust just because we have more limited policy space. Governor Bailey spoke in a different context about the difficulties when monetary or when price and financial stability hats sit on the same head. How does this translate in the risks of climate change and tightening and the higher risks of recession that are making investment so necessary for climate action more difficult?
Thank you. We'll take a final question from the Governor of the Reserve Bank of New Zealand, Adrian Orr, and then Ngozi.
Thank you, panel. My question is for Niall, and I was really asking where you see the risks now that the big countries have woken up and are tightening at pace. Do you think that the rest of the world will now have to do less tightening because the work is being done, or more tightening because our headline inflations are rising with falling exchange rates? So where do you see the risks with your historical perspective?
Excellent question. Thank you. Ngozi Okonjo-Iweala.
really wonderful panel. I just wanted to say I've heard the central bankers refer now and throughout the meetings to the worries about the tight labor market and the disappearing labor, which still needs to be understood. Could you just explore this a little bit and what your biggest fears are and what it means for monetary policy and the balance you're trying to achieve? I just want to hear a little bit more. And for Professor Ferguson, maybe you can go a little bit behind the scenes on the disappearing labor and tell us historically whether you've seen this and what it means and what we should understand from it. Thank you.
Thank you.
And why are you afraid of some of the possible solutions to deal with this problem?
Thank you. So we are tight on time, so if you can, I'm afraid I have to constrain each of you to 2 minutes in your replies. Andrew, you want to start?
2 minutes, right, very quickly, to Jim's question. I think the story in 23 is a bit of everything, actually. So there clearly is policy tightening coming through for all of us. I say this, although, I'm in danger of being told that I probably said this 6 months ago. Of course, on the energy front, for inflation not to come off, energy prices have got to go on rising, and, I sort of sincerely hope that doesn't happen. And then, of course, to go back to what I was saying earlier, of course, the other things equal point about second-round effects, and we are going to have to stay very focused on the risks and second-round effects. On the stay in lane, the second question, I think the interesting question. I'd sort of go back to where Kristalina started. I think there is a very important role, and I think the IMF is a very important part of this, of pointing out the economics of this. But I would make the point, I've sat in many international meetings, as Klaus and Haruhiko do. We do not say, well, you can't pursue a response to Russia because inflation's a bit high. We all recognise the critical importance of what is going on in Ukraine, and we have to deal with the consequences of it. On climate change, I would say this. I think that we have to factor climate change into our everyday business, both as regulators and as monetary policymakers. So that is why we've put so much emphasis on, Francois has been a leader in this, in terms of the economic modelling. And I would just encourage, please support us and keep doing this because it's critically important. On the labour market, it's a great question. I'd really be interested in Niall's views on the history of this because I think it's where we could really benefit from that. What we're seeing, I'll talk in the UK, is an increase in inactivity. In other words, people who are choosing not to work. It's older people. And the labour force survey tells us that the biggest reason when they're asked is long-term health conditions. Now, I'll just finish by saying, we don't know. I've heard 3 possible explanations for this from public health and from health economists. Long COVID, people with pre-existing health conditions who were confident to be in the labour force when COVID wasn't there, but are not confident at the moment when COVID is there. And then thirdly, sadly, that our health, our public health and our health systems are not treating people as promptly now in a COVID world and with the consequences as they were in the past. And of course, that sadly means, people with other conditions are becoming more unwell and not able to work. I don't know the mix of those, but of course, they're all possible.
Thank you. Klaus?
Yeah, first on 2023 inflation, excellent question, I think, Jim. But if you go back for a moment to the first slide that I showed, in the euro area, a lot of inflation is the energy shock, the negative surprise. Well, if you look at energy prices, obviously they started to rise already in the second half of 21 when Mr. Putin started to play with us. But there is this huge spike in February, March, surrounding the invasion, which by the very nature of it will sort of peter out of the data in 2023. Now, if Neil is right and there were to be a significant escalation of the conflict in 2023, then of course you cannot exclude new energy shocks. But they would then have to take energy prices to even dramatically higher levels than they currently are. If that is not the case, then I think, ceteris paribus, it is a reasonable assumption that inflation will come down in 2023. The big question is how much and how quickly and how strong will the traditional, let's say, Phillips curve effect be when our economy begins to slow down. And on that, I think there are sort of there is a range of views on how strong that effect will be. And indeed, also Andrew mentioned, we started changing our policy posture in the euro area in December 21. So if you take the normal 18 to 24 months, yes, in the second half of 23, I would also expect that some of that changing monetary policy posture begins to kick in the inflation developments in the euro area as well. On the point of the war, and I have little to add to what Andrew said, with one exception. The sanctions that sort of were constructed in the course of 2022, from my end, I have observed that there was communication beforehand also with financial authorities on what would be the consequences of these sanctions, how would they bite, how can we construct them in a manner that we don't shoot ourselves in the foot and create a financial instability event in our own sort of financial system, etc. So there, the communication has been there. But of course, if it comes to questions about pushing buttons and launching missiles, I don't expect that they will call the chair of the Financial Stability Board before taking such a decision. Last very brief point on the labor market. We did not in the euro area have so much decline in labor force participation than in other parts of the world, simply because a lot of the fiscal support during the pandemic was actually on-the-job support. It was support for the employers to keep the employees so that they would continue to receive their salary, unlike the US, where it was much more income support. So we didn't have this huge decline. It's less of an urgent. Our labor market is very, very tight, continues to be very tight. The old elderly with health issues that are reluctant to come back, yes, that issue is clearly also there in the euro area, but overall it's to a lesser extent than elsewhere.
Thank you.
Just inflation in 2023, as well as labor market conditions, I totally agree with Klaus. Just one comment on climate change. I think this is a long-term challenge, and we have to address this probably the most serious and important issue in this century. So, by the way, Bank of Japan recently introduced a special facility to provide funding to financial institutions which finance climate change mitigation projects. And this facility will continue at least in the next 10 years.
Thank you. No.
4 very brief responses. I know we're out of time. To Jim Bullard, I guess I struggle to believe in the story of returning to pretty close to 2% PCE by 2024 because it needs nothing else to happen. And that's only in economics that nothing else happens. You'd need the war to stop, for one thing. The war is not going to stop. There's absolutely no obvious way in which this war ends. And as I said, there is a significant risk of escalation in other regions. I think your point about divided government and a more active Fed is interesting. I don't know that it leads me to expect a soft landing, though. And the reason is that I remember Alan Meltzer's account of the Fed's conduct of monetary policy in the 70s. Nothing that this Fed has done so far differs from what Arthur Burns's Fed did. Just to be clear. So it's all very well to invoke the name of Paul Volcker, but let's just look at the Burns Fed's performance. They raised rates, but when the going got tough, they paused or reversed course. And nothing has happened to date to persuade me that that won't happen again. And I believe it will happen when the first signs of trouble in New York, in the US bond market, appear. And we'll look back and say, what happened in London was actually just a warning of what was going to happen in New York. You will not get to a non-accelerating inflation rate of unemployment of whatever it is. I don't know, Larry says 6%, before financial stability issues force you to change course.
The UK now.
Second point, climate change is inflationary, and so are most of the things that we're doing to mitigate climate change. Let that sink in. To Adrian Orr, the risks to the rest of the world are that the Fed will continue pursuing this supposedly Volcker-esque policy. The dollar will strengthen as it did during Paul Volcker's time in the early 80s, and that will put intense pressure on the rest of the world, especially the rest of the world that's indebted in dollars. This is a point that Gita Gopinath has made rightly and others have made. Finally, the good news is that I think the Fed will blink. And at that point, all these trends will reverse themselves, rather as happened in the mid-80s. And finally, I think that the question that you raised about the labor market is a super interesting one, because it's very hard to find in the past societies with such elderly populations and low fertility as we currently see in most of the world, except Africa. 95% of the projected increase in population in the world between now and the end of the century is going to be in sub-Saharan Africa. And so the huge question that comes to my mind is not just about public health, though I think Andrew Bailey is right to emphasize that. I think we have an even bigger problem with this in the United States than in Europe. But there's a huge question about immigration, which goes, I think, largely unaddressed here. Legal immigration into the United States has effectively stopped. Illegal immigration is going gangbusters, but the legal variant has basically stopped. And this looks like a huge policy own goal. It's also inflationary. I mean, you can't really expect the US labor market to be responsive to the needs of business if you don't have any significant legal immigration. So I think the huge unanswered question, and it's posed not just by the issues I talked about, it's also posed by climate change, is there going to be large-scale emigration from Africa in the coming decades of this century? And if so, to where? Will it be managed or will it be chaotic? Those are huge questions. They're beyond the scope of monetary policy, as most of the things I've talked about are, but that's the reality of the historical process, that central banks have to contend with many more challenges than the relatively narrowly defined ones of price stability and financial stability.
Thank you. And it does really bring us back to Pier Carlo Paduan's question on long-term fiscal policy. It's a fundamental challenge we now face. Jacob, would you like to have a quick word?
Well, just very few words. First, there was a question, what keeps us up at night? I think those of you who listened to the discussion got a lot of reasons to keep us up at night. There was a lot of discussion about monetary policy, as if this is the key. Most of the crises today do not emanate from monetary policy. Except for inflation, most will not be solved by monetary policy. So there comes the question, therefore, that former Minister Paduan mentioned. So what do we do? What other tools do we need to have? I don't think that it is another forum or another discussion among people. I think the real issue is what we did not discuss. In order to have flexible economy, you need to have structural policies. There is no appetite to do it at all. We have here Ngozi, the head of the WTO, who just reported, not today, that trade in the world is going to grow at the slowest pace since the previous deep crisis, and trade growth is associated with global growth. So we are in deep trouble. It's not to be solved by a meeting of Minister of Finance and ministers and governors. Kuroda-san and myself are old enough to remember when we met first in the Plaza in Louvre. This was a different world where you thought that you can do everything by either central bank governors or ministries of finance. Without the trade ministers and the other ministers who deal with structural issues, it will not come up. So the issue is not let's find a place to meet, but let's discuss what to discuss. Please.
Thank you to all our panelists, and please join me in thanking them for a very thoughtful discussion.